So there are a few trends I think I would highlight. One, so far for banking.
In today's Fund Face-Off, we'll be discussing two RBC funds, RBC Monthly Income and RBC Canadian Equity Income. The common denominator between the two funds is its equity manager, Jennifer McClelland, who we had an opportunity to meet with in recent months. So Adam, take us through what differentiates the two funds.
Well, the main differentiator would be the fixed income sleeve of RBC Monthly Income. It's led by Suzanne Gaynor and the deep bench of fixed income analysts at RBC. But what we found interesting, and I think what we wanted to focus on today, was sort of the difference even within the equity mandates. The RBC Canadian Equity Income is co-managed by Bram Spilfogel, who is a manager on RBC Precious Metals and Global Resources. And he brings an energy expertise to the table. And he and McClelland sort of interact with each other and make independent decisions, but that complement each other.
And now Monthly Income, it's a more conservative type of mandate, right? So within that sleeve, it's mostly the large cap names that I think she kind of wants to hold. It's more of a buy and hold and make sort of adjustments at the margins, really, as opposed to Canadian Equity Income,
right,
where it's more of an aggressive type.
Yeah, I think McClelland has a similar process to each of the funds. You know, she uses RBC's 3D score that has been really touted throughout the firm, but she has a bit of a different approach to each. Canadian Equity Income is a much smaller mandate. It's $700 million as opposed to the multi-billion-dollar Monthly Income fund. So she feels like there's a little bit more room to move. She has a bit more of a momentum focus when it comes to looking at the 3D scores, and where in Monthly Income she may make a small move in a certain direction that she believes in, she may make a larger move in the CEI fund.
Right. And so in Canadian Equity Income, while it's smaller and she still has that ability to move into sort of smaller and mid-cap type names, it has grown quite a bit over the past couple of years, tenfold specifically. And so, you know, that's something that we'll be keeping an eye on to see if it continues to grow at that pace. Maybe that flexibility might diminish over time as well.
Yeah, and I think one other important difference between them is the turnover of each fund. You know, because Canadian Equity Income is a smaller fund, and because they move around a little bit more based on their convictions, there's turnover in the fund that's actually reached over 500% in the last couple of years. Now, there's nothing wrong with high turnover if it's part of your strategy. The fund certainly performed very, very well, but the one effect of having that kind of turnover is turnover expenses. Now, that's not included as part of management expense ratio, but in the case of that fund, it's actually doubled the overall cost of the fund. So that is, you know, something to consider in the sense that it's something of a larger hurdle to overcome before it can ultimately be profitable for unit holders.
Yeah, it's an additional cost that affects the performance and the results that unit holders see. But overall, you know, it's both funds have performed very well, and she's a manager that we have a favorable opinion of. So depending on an investor's risk profile, either one of these funds could make sense in their portfolio.